Welcome to day 3 of recording transactions into the ledger. Now make sure that you have your flashcards and your pen handy because you're going to want to take notes today. In accounting, it's very important that you revisit this information and it stays in your brain long term. So we're going to go over the basics of recording general ledger transactions. And before you even start recording an entry, you must remember that the accounting equation must always be in balance. And to recap, the accounting equations of assets equals liabilities plus equity is what a company owns, assets, versus what a company owes, liabilities, owes to the shareholders, equity. So what is a transaction? A transaction is any financial event that impacts a company's assets, liabilities, equity, revenue, or expenses. So I know that's a lot. To sum that up, it's anything that happens in the company needs to be recorded. And why does it need to be recorded? So the balance sheet, income statement, and statement of cash flows can be up to date. Now, when you first put together your journal entry, there's a couple of key components in place. And first, we're going to talk about account. Now, account is a specific record used to track changes in particular aspect of the accounting equation. And some examples of accounts are listed in the accounting equation in the screenshot right here. This is a time where you'd want to get your flashcards and write this down. Accounting follows a double entry system where each transaction affects at least 2 accounts. Every transaction is recorded with a debit entry and a credit entry, and this ensures that the accounting equation remains in balance. And remember, if the accounting equation is not in balance, you need to investigate your variance and correct immediately. So you might say, Casey, what's a debit and what's a credit? And these are 2 sides of the accounting entry that records the changes in account. Editing me here. So to clarify, debits go on the left side of the T account and credits go on the right. Now, I think it's easier actually if we go over a transaction and then this will all start coming together. So when you're putting together an actual journal entry or account transaction, you're going to want to populate 4 key components. First up, the date. Second, the account. Third, a line description. And finally, the amount. So first up, the date. Why is it so important that you report the correct date? Well, you want to make sure that you're recording the entry in the period incurred. For example, let's say someone on the sales team sold something March 31st and you date it April 1st. You might think, well, that's not such a big deal. It's just 1 date difference. Well, it is to the person who sold the item in March because that's Q1 and they want to get their Q1 bonus. So remember, revenues and expenses need to be recorded in the period incurred. Account. Various accounts will roll up under assets, liability, equity, revenue, and expenses. And some examples under cash would be cash and equivalents, liabilities, accounts payable, equity, common stock, revenue, sales revenue, expenses, salaries expense. So whenever you're starting to book your journal entry, you need to think, where does this go in the balance sheet or income statement? And that's the account that you'll select. And finally, you're going to want to write a description because sometimes the chart of accounts doesn't get as granular as you need. And we'll go over a description on one of the examples below. And the very last thing you need to do is select the amount because you don't want to accidentally write 5,000 if it's for 500,000. So it's very important that you always review your work. Okay. So the first example, in September, you bought a curling wand for your business for $500. So what do? You first write the date and you debit equipment for $500 and you fill out the account line description of curling wand, and then you credit cash and you populate the line description of operating of $500. And this shows that equipment went up and cash went down. Second example, you needed to buy a computer for $3,000 and you purchased it from Apple on account. So what transaction do you record? First, you populate the date of October 1st and you debit computer and you populate the line description of MacBook so you know what kind of computer you bought, and you debit computer for $3,000, and then you credit accounts payable for $3,000, and you put in the description Apple, knowing that you're going to have to pay Apple back at a later date for $3,000. And finally, you do a wedding hairstyle on November 1st for $250. The problem is you were sick for 2 weeks and you forgot to record the transaction. So do you put 11/15 on the day you're there recording the journal entry? No, you write the journal entry, the period incurred. The day that you did the hair is the day that you record the journal entry. You hear me? So what do you do there? You debit cash, you put a note that it's in the operating account for $250, cash went up, and then you credit sales revenue because you earned $250 in sales. So you made it to the knowledge check. What is the purpose of recording transactions in accounting? A, to increase assets only. B, to ensure the accounting equation remains in balance. C, to minimize tax liabilities. The answer is B, to ensure the accounting equation remains in balance. Let's do another one. In double entry accounting, which accounts increase with a debit balance? Assets and liabilities, assets and equity, liabilities and equity. The answer is B, assets and equity. Now I challenge you after this video to go download your favorite company's balance sheet and income statement. And what I want you to do is look at the assets, liabilities, equities, revenue, and expenses section, and by all of the accounts, I want you to write debit or credit, and this will help you learn what accounts are assets that would have a normal balance of a debit and what accounts are liabilities that would have a normal balance of a credit. But we will get into more of that later. And remember, if you got these answers wrong, then you need to rewatch this video, and don't forget to pick up my book, Accounting Essentials, Master the Basics in 10 Days.